Blockchain has been hailed as one of the most transformative technologies of our era. Its decentralized, transparent, and tamper-resistant nature has opened doors to new business models in finance, supply chains, healthcare, and most recently, real estate tokenization. The idea of owning a fraction of a property through a digital token feels futuristic and inclusive, giving ordinary people access to investments that were once reserved for wealthy elites. But while blockchain itself is a neutral and powerful tool, bad actors have learned to use its complexity and hype as a shield for fraud. Instead of empowering investors, many tokenization projects mislead, overpromise, or outright deceive their audience. For the average person who doesn't fully grasp the intricacies of smart contracts, liquidity pools, and securities laws, this creates fertile ground for scams. This article exposes how fraudsters exploit blockchain, why investors are vulnerable, and why stricter legislation, checks, and licensing are urgently needed before real estate tokenization can truly benefit the public. Blockchain's promise in real estate. Before diving into the dark side, it's important to acknowledge the genuine advantages blockchain brings to the real estate sector. Transparency. Every transaction is recorded on an immutable ledger, reducing the chance of hidden deals or tampering. Fractional ownership. Investors can buy small portions of high-value properties, making real estate more accessible. Efficiency. Smart contracts automate payments, rent distribution, and transfers, cutting down on costly intermediaries. Global reach. Investors from different parts of the world can participate in the same property project. These innovations hold enormous potential. The problem arises not from blockchain itself, but from how unscrupulous projects exploit its complexity to hide flaws, inflate promises, or avoid regulation. The Fraudsters Playbook: How Scams Work. Fraudulent real estate tokenization projects often follow a familiar pattern. 1. Hiding behind technical jargon. Scam promoters use complicated blockchain terms, smart contracts, DEX integration, liquidity pools, to impress investors who may not fully understand them. In reality, the underlying property rights are often vague or unenforceable. 2. Selling the liquidity dream. One of the biggest lies is the promise of instant liquidity. In theory, tokenized property shares can be traded on blockchain markets. In practice, very few active buyers exist, meaning investors often can't resell their tokens at all. Liquidity remains a myth, but fraudsters continue to market it as guaranteed. 3. Unverified property ownership. Some projects sell tokens tied to properties that are mortgaged, disputed, or not even owned by the company. Since many investors are overseas, they rarely verify the legitimacy of the property deeds. 4. Unrealistic or guaranteed returns. Legitimate real estate has risks and fluctuating yields. Fraudsters lure investors by promising guaranteed annual returns, sometimes higher than what the rental market can realistically support. 5. Regulatory loopholes. Projects often set up in jurisdictions with weak oversight. This allows them to market globally without facing tough securities laws. For example, some platforms openly admit that while they tokenize U.S. properties, U.S. citizens themselves are restricted from buying most of them due to regulatory barriers. This contradiction alone should raise red flags for investors. The case of restricted access. Consider this scenario. A company purchases real estate inside the United States and then tokenizes it for investors worldwide. Sounds legitimate, right? But here's the catch. U.S. citizens, the very people living in the country where the asset exists, are prohibited from buying most of these tokenized properties. Why? Because U.S. securities law is strict, requiring extensive licensing, disclosure, and compliance before such offerings can be made domestically. To avoid penalties, these companies simply restrict Americans and instead target foreign investors, who may not benefit from the same legal protections. This highlights a troubling reality. If the regulators in the asset's own country don't allow their citizens to participate, why should outsiders trust it? Fraudsters exploit these gaps, creating the illusion of legitimacy while sidestepping serious oversight. Why investors fall for it? Several psychological and informational gaps make investors vulnerable. Blockchain hype. Many still believe blockchain automatically means transparency and fairness. Fear of missing out. FOMO. Investors rush in, worried they'll miss the next Bitcoin of real estate. Complexity barrier. Few take the time to understand securities law, property rights, or smart contract mechanics. False credibility. Glossy websites, buzzwords, and partnerships with minor exchanges can trick people into thinking the project is trustworthy. Why regulation is critical. Blockchain innovation should not be stifled. However, without proper legislation, controls, and licensing requirements, fraudsters will continue to exploit the gray areas. Here's what's needed: licensing standards. Any company selling tokenized property should be licensed by a recognized financial authority, just like traditional brokers or REITs. Property verification regulators must ensure tokens represent legally enforceable ownership or profit rights, not vague promises. Smart contract audits. Mandatory independent audits should verify that smart contracts don't include hidden backdoors. Clear investor protections. Foreign investors should have transparent recourse options if projects collapse or mislead. Disclosure requirements. Tokenized property offerings should provide full details on rental yields, management costs, liens, and risks, just like securities filings. The positive path forward. It's important not to dismiss real estate tokenization entirely. When done correctly, it can democratize access to wealth-building assets, reduce costs for property transactions, enable global real estate investment opportunities, improve transparency in traditionally opaque markets. The key lies in balancing innovation with accountability. Just as traditional stock markets evolved with regulation after early abuses, tokenized real estate requires a strong framework to mature into a safe and reliable asset class. Conclusion. Blockchain is not the villain. It is a groundbreaking tool with enormous potential to make real estate more accessible, efficient, and transparent. The problem lies with fraudsters who twist its features into traps for unsuspecting investors. The contradiction of companies tokenizing U.S. properties while blocking U.S. citizens from participating is a glaring warning sign. If the technology is truly revolutionary and legitimate, it should withstand the same scrutiny and regulation as any other financial instrument. For tokenized real estate to fulfill its promise, governments must step in with strict legislation, licensing, and verification standards. Only then can blockchain's benefits shine while fraudsters are kept at bay. Until that day, investors should remain cautious, skeptical, and diligent. Because behind the buzzwords of smart contracts and liquidity pools, lies can hide in plain sight. Settings. Make the background music info. Add bold subtitles with popping effect. Use YouTube audio. Library. Only use appropriate media. Don't use iStock. Use a male voice with a New Yorker accent for speaker 3.